Good morning, students. It is 11 o'clock, so let us start with our first class of this winter school of ours. I'm not going to want you to watch my talking head all day long, so don't worry, I'll disappear pretty soon. Good morning, Bobby. Um, what we are going to be focusing on would be the conceptual framework, first of all, today. That is the first topic of Financial Accounting 2. And then once we're done with that, we're going to look at IAS number 1, International Accounting Standard number 1, which deals with the presentation of financial statements. And then once we've done with that, which is mostly theory, then we're going to apply it in practical situations. So then we're going to apply the conceptual framework for financial reporting as well as IAS 1 in practical situations by drawing up a statement of comprehensive income, a statement of changes in equity, a statement of financial position, as well as the notes that must accompany that. But before we do that, I think let's start really at the beginning. Where do the IFRSs or the financial reporting standards and the framework, where do they all come from? It really comes from the fact that trade has been globalized over the last 50 or so years. In the old days, trading was very much localized. You would trade with your neighbor or you would trade with somebody a little further away, but we didn't really have global trade. So the accounting systems that we know, and we do know that accounting has been with us for more than 2,000 years. Very often people say, but people couldn't write 2,000 or 3,000 years ago, but that is wrong. People could write, it is just what they were writing on didn't survive, so we do not always have the text available. But there is text evidence that accounting records were kept 2,000 to 3,000 years ago, even inventory counts, how many vases of corn do I have, or how many heads of cattle do I have in the field. So let's maybe just start by looking at how accounting has developed, especially over the last 50 years or so. Up till about the 1970s, when globalized trade wasn't so prevalent yet, each country basically had their own accounting standards, what we generally refer to as GAAP, GAAP, Generally Accepted Accounting Practice. Perhaps I can just type a few things for you here. I hope you can see my whiteboard. So GAAP, which stands for Generally Accepted Accounting Practice. So each country would have its own set of standards. South Africa had its own set of standards, the so-called AC series. We also had a conceptual framework. But the need really became in the 1970s when trade was globalized, that there should be consistency, that there should be some sort of standard worldwide applied to how financial statements are prepared, to how certain items are presented in the financial statements, and so forth. And for that reason, a body was established which was called the IASC. This, by the way, is not for test purposes. This is truly really for you to understand the background of where we are going. The IASC, that stands for the National Accounting Standards Committee. And they were tasked with drawing up standards that could be applied by all countries worldwide. Why? Because of the globalization of trade. There we go, generally accepted accounting practices. Thank you, Mr. Borman. I see you have also joined our session. Excuse me. So that we have a situation where investors in certain countries do not only invest in companies in their own countries anymore, they also invest in companies that are registered and has a domicilium in other countries. So a South African may want to invest in an Australian company or a Nigerian or a Belgian company, or a British person might want to invest in a German or French or South African or Canadian company. Therefore, they have to study the financial statements of those entities, of those companies in all the other countries. But as you can imagine, if each country, if they use their own set of standards, then it becomes very difficult to compare the financial statements, the results of the operations, or the financial position, or the cash flows, if there is no consistency in presentation. And for that reason, the International Accounting Standards Board, Council at that stage, or committee, I should say, they established a framework, which we will be discussing most of today, to establish the foundation on which the further standards would then rest. Over the subsequent few decades, they issued a number of international accounting standards, in fact, 41 in total. And those standards were called the IAS series. IAS, and maybe I can type there, that stands for International there's no I there, sorry, IAS. That stands for International Accounting Standard. So there was an International Accounting Standard number 1 released that deals with inventory, number 2 and number 3 and number 4 and so forth. During this third term, you're also going to be learning about International Accounting Standard number 16, which deals with property, plant and equipment, and it went all the way up to IAS number 41. Then for legal reasons, about 30 years ago, an international foundation, the IFRS Foundation, was formed, and due to all sorts of legalities, it was decided to dissolve the IASC, and a new body was established, which is still with us today, which we call the IASB. And that's the one that I'd like you to remember. The IASB, that stands for the International Accounting Standards Board. International Accounting Standards Board. Like I say, this is the one that we still have with us today. So they've continued, well, first of all, they have adopted the original IASs. Now I see there are 2 I's there. Anyway, it's only one IAS. So they've adopted the original 41 IASs, IAS 1 to 41. But since then, they've released a further series of financial reporting standards, which we do not refer to as the IASs anymore. We now refer to them as the IFRSs. Martle, I see that your hand is raised. I'll give you the opportunity to ask your question. I just want to finish this little background story, if you don't mind. So they've continued with further standards, and now we call them the IFRSs, which stands for the International Financial Reporting Standards. As of today, if I remember correctly, they've issued 17 further IFRSs, IFRS 1 to 17. 15, 16, and 17 was released at the same time. I think it was in 2018, if I'm not mistaken. Anyway, some of them are new, but some of them actually replaced some of the old IASs, the old International Accounting Standards. Okay, so that is my opening story for this morning. The fact is that the first document that we've got to study before we go to any further standards is the conceptual framework for financial reporting. Why? Because that forms the foundation upon which all the other standards are built. As we'll see later today, or possibly on Thursday, we'll see how far we get today. We'll see, for instance, that certain elements are defined within this conceptual framework. We'll talk a lot about elements today. We're even going to talk about the periodic table. Be that as it may, then for certain kinds of elements, there are further requirements. For instance, one of the elements that you probably know already is an asset. But an asset could be a current asset, it could be a non-current asset, it could be something like inventory, it could be something like property, plant and equipment, or intangible assets, or financial assets, or even biological assets, which we'll talk about when we get to IAS 1. The fact is they have different attributes. For instance, inventory is held for the purposes of trading, right? You're not going to keep it for a long time. For instance, to manufacture a product, it is your product, right? So the shorter you keep it, the better. Whereas property, plant and equipment, you are owning and holding for a long period of time, either to produce inventory for you, or to deliver your inventory, for instance, or to make the administration of your business possible. So clearly that already they have different attributes. So therefore we've got, for instance, IAS 1, which deals with inventories, which then provides us further definitions. Further definition, what is inventory? Once we have decided in accordance with the conceptual framework that the item, the element is an asset, what then makes it inventory? Or let's say, for instance, in the case of IAS 16, which we are going to be dealing with very soon, what makes an item to be property, plant and equipment? What distinguishes it from inventory, say, or from an intangible asset and so forth? So the conceptual framework provides us with this foundation, and it provides us, amongst other things, with definitions of the various elements. But then the standards go further, and then they tell us what should we do once we've defined this as property, plant and equipment. How should we record it? How should we measure it? What value should we put attached to it? For instance, how do we determine the cost? What is part of the cost? Is it the purchase price? Is it perhaps some other kinds of costs that must be added there? And then eventually, how must we disclose it? We're going to use the term the users of financial statements quite a bit today, because ultimately, at the end of the day, the reason there's something like financial accounting is that we want to report what our results were. And we want to report what is the position, the financial position of this company. Or we want to report what the cash flows were. And we'll see a little bit later, who do we report it to? Yes, primarily the owners of the company, but there are also many other interested parties, for instance, the creditors of the company, or potential creditors, or not only the current owners, the shareholders in the case of the company, but potential shareholders, somebody who might be interested in acquiring shares in this company. You all now know very well what shares are, right? Share capital. We've done share capital very recently, right? So that is a means by which either a private individual or another institution or some sort of other company or institutional investor can become a part owner of this company, right? So clearly, those are interested parties, and we refer to them as the users of the financial statements. Not to forget also the Revenue Service, the South African Revenue Service, or the British Revenue Service, or the IRS in the United States, the Internal Revenue Service. They are all interested in the financial statements of a company, right? Okay, so what we need to do now, once we understand how everything fits together, that we start with this conceptual framework, which forms the foundation of the further standards, then we can go and study the standards. Eventually, obviously, we must apply all this knowledge. So let's just maybe at this stage pause a little bit. I know there was a hand raised. Let me just have a look. Who was it? I think it was Boo. Was it something you wanted to ask? Okay, doesn't seem to be a question at this stage. Right, so now let's go and have a look at the conceptual framework. Now it's quite a massive document. It's quite a large document, but we are not going to study the entire document. In fact, you probably already know. Well, you definitely know that you started studying the conceptual framework for financial reporting in Financial Accounting 1. So now we're just going to take it to the next level. So we're going to study it at a more advanced level than before. Let me just find it. Just want to share this application, the Conceptual Framework for Financial Reporting. Right, you should all be able to see the conceptual framework. Like I say, it's quite a large document. It consists of, I think, 86 pages, but there really are basically 28, 29 pages that are of interest to us. Why I'm saying not all of the pages, as you will probably see if you go and read through the document, there's a lot of reasonings behind decisions which doesn't really interest us. And all sort of justifications. We just want to look at the heart or the nucleus of this document. Are there any questions, perhaps? Okay, so this is the 2018 version. It's the Conceptual Framework for Financial Reporting. We can see that it was revised on the in March, during March 2018. So there are a few differences between this revised version and the previous version, which was issued in 2010. Let me just disappear from the screen for a while. So we are looking at the very latest edition. So let's just have a look at the table of contents. There you can see this is issued by the IFRS Foundation, the International Financial Reporting Standards Foundation, and the active body is the International Accounting Standards Board. So there are, I think, 9 chapters or 8 or 9 chapters to this document. Chapter 1, we are briefly going to discuss the objective of general purpose financial reporting. What will be quite important for us is that little sentence or that little paragraph there, economic resources and claims, also changes in economic resources and claims. This concept, the concept of accrual accounting, is a very important concept in financial accounting. So we're going to spend quite a bit of time discussing that. Also, when we look at the International Accounting Standard 1, which will not be today already, it'll either be from Thursday or next week, then we are going to come back to accrual accounting. We're just briefly going to talk about cash flows, but cash flows we are really going to cover in the 4th term. In Chapter 2, we're going to look at qualitative characteristics of useful financial information. So we'll see when we get there with fundamental qualitative characteristics and also enhancing qualitative characteristics. So we'll discuss each of them at that stage. In Chapter 3, what we are going to be looking at would be the objective and scope of financial statements, the reporting period, the going concern assumption. This is what they refer to as the underlying assumption, and we're briefly going to talk about the reporting entity. Probably the most important chapter, in my opinion, all the chapters are really important, but possibly the most important one is this Chapter 4, which deals with the element of financial statements. So we're going to discuss what is meant by elements. I joked a little bit earlier, I'm even going to bring the periodic table in there, but you'll see why then. Right, so there we will find a definition of an asset. We will discuss that when we get to it. We will discuss the definition of a liability. So that's all part of Chapter 4. We're going to discuss various aspects of those definitions. We're going to look at equity. Equity, what is meant by equity, how is it defined, and then also income, and then lastly expenses. So for each of them we're going to have a definition, and we must not only know the definitions, we must also be able to apply the definitions. The reason for that is I know that many of you already have developed a gut feel. You would recognize what is an asset, what is a liability, or any of the other elements, but you could get fairly complicated situations, which is not the run-of-the-mill daily occurrence, which might be a little bit more difficult to decide whether this is actually income or a liability, or whether it's actually expense or an asset. And the definitions therefore guide us in making that kind of decision. We're going to talk about recognition as well as derecognition, the one just being the opposite of the other. We're going to look at relevance. Amongst the recognition criteria, we're going to look at faithful representation. Perhaps this is a good time to take a note when we see the term faithful representation. Later on, we're also going to encounter a term in IAS 1 that is called fair presentation. And a fair presentation is not identical to a faithful representation. We'll see later on this week that a fair presentation does include faithful representation. It does include relevance, but it's not an identical term. And then derecognition, as we said, is just the opposite of recognition. Another important chapter is the one that deals with measurement. So here we are going to look at measurement in general. So what is acceptable basis for measurement of any kind of element, whether it be an asset or a liability or income or expense or equity. And then the further financial reporting standards and IASs will give us measurement bases that are more advanced than these, but they only apply to that specific kind of element that financial reporting standard deals with. So we'll see here there are certain measurement bases, but then there are further measurement bases, let's say in IAS 16, but that only refers to property, plant, and equipment. So here we will see there's the historical cost and the current value basis and so forth. So there are quite a number of aspects that we are going to be talking around measurement. Presentation and disclosure. We're briefly going to discuss presentation and disclosure as well. Then chapter 8, we're not going to be doing in financial accounting 2. We can leave that until a further financial accounting level that deals with concepts of capital and capital maintenance. Okay, let's maybe just pause there. Are there any questions from your side? You're welcome to raise your hand and then you can pose your question, or you can type a question in the chat box there. I guess the first question that many students will ask is this only theory? Yes, at this stage it is only theory, okay? We have to understand and know the theory first, and then we can apply it. In fact, I can go so far as to say, Mr. Borman can confirm this. Good morning again, Mr. Borman. Can confirm this as well. The class test 1 that you will be writing, when is it? Mr. Borman has typed there on the 18th of August, is going to be purely theory, right? And it's going to be on the conceptual framework. So we must understand the theory first. Then when we get to the formal test 1, which Mr. Borman has indicated there is on Tuesday, the 25th of August, that will then include International Accounting Standard 1, the theory thereof, but also, as Mr. Borman typed there, the application, the practical application in how to draft or compile your statement of comprehensive income and financial position, the notes there too, as well as your statement of changes in equity. Okay, so let's let me maybe make this larger again. So when it comes to the status and purpose of the conceptual framework, I'm not going to read this whole document with you. We're just going to go through the highlights here. So the conceptual framework for financial reporting, which we simply refer to as the conceptual framework or CF, describes the objective of and the concepts for general purpose financial reporting. And the purpose of the conceptual framework is to assist the International Accounting Standards Board, right? We've just spoken about that a little while ago. that's the IASB, to develop international financial reporting standards that are based on consistent concepts. Consistent, like we said, all over the world, that companies, wherever they are situated, they use the same kind of standards. Also to assist preparers to develop consistent accounting policies when no standard applies to a particular transaction or other event, something that is really strange, that we haven't encountered before, or when a standard allows a choice of accounting policy. And thirdly, also to assist all parties to understand and interpret the standards. Interesting to note, the standards themselves, they are not complicated, but sometimes they are a little bit ambiguous. So there may be more than one way to interpret that. And the International Accounting Standards Board has actually issued a further set of documents that they call the interpretations. We're not going to talk too much about that, but perhaps you must just know that there are also interpretations that are released by the IASB. The second paragraph there, we've mentioned that the conceptual framework itself is not considered to be a standard, but it does form the foundation of the standards. Nothing in the conceptual framework overrides any standard or any requirement in a standard. The reason for that is the framework is basically general. It's like almost a generic document, but then the standards apply to specific situations. For instance, IAS1 applies to specifically inventory. So because it is aimed at a specific situation or a specific area in your financial statements, clearly that standard will then override the conceptual framework, right? Because it is almost a situation where that standard specializes in that specific element, property, plant and equipment, or inventory, or whatever the case may be. Let me just see what else. Most of that, again, is just background information or justification of why certain decisions have been taken. So now we can get into the document itself. So chapter 1, the objective of general purpose financial reporting, and we're going to look at objective, usefulness, limitations, and so forth. So let us scroll down. This is the one, paragraph 1.2, that I'd like us to start with. Here they say the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful, right? So that is the first little item that or word that we must highlight here. So it provides, perhaps it's the second one. The first one is actually the financial information, right? So to provide financial information about the reporting entity, in other words, the company or the CC or whichever kind of business it is, or even government institution that is drawing up the financial statements, that is useful to whom? To either existing, in other words, the ones that are currently with us, or potential, existing and potential what? Either investors, right? Investors. So who would be our, perhaps you can type for me there, who would be our existing investors? The reason why I want you to type this is because we've done this very recently, not even 2 months ago. So who would be considered our existing investors? Type for me there, please. Students, have you had your coffee? There we go. Thank you, Bobby. You are on fire. Yes, the shareholders, right? So our existing investors would be our current shareholders, the people who have invested money in the company. There we go. Thank you, Mr. Borman. So your shareholders are your existing investors in the company. And then also people who might be interested in investing in the shares of the company. They might not be your existing or your current shareholders, but they are doing market research. They are looking at your company and maybe 3 or 5 or 7 other companies, and they want to make a decision what would be best for them, what would be their optimum investment, in which company should they be investing in. And then also existing and potential lenders, in other words, financial institutions who might be lending money to the company, or the company will be borrowing money from them, and also existing. Why do I miss the first letter every time? Also existing and potential creditors. The people who are providing us with credit facilities, clearly they need the information. They're not going to grant you R1 million worth of credit facilities if you cannot repay that, right? And then why, in making decisions relating to providing resources to the entity, right? Clearly, in the case of existing and potential investors, they will provide what kind of resources? Capital for the company to start up, or capital for the company to expand, or even to merge or take over another entity. In the case of lenders, they will provide resources again in the form of money. Creditors will grant us credit facilities. In other words, we buy today, but they allow us to pay in 28 or 31 or 60 days time, or whatever the case may be. So those decisions obviously then involve things such as the buying, selling, or the holding of equity and debt instruments. Now, let me again test again how awake you are. What would be a typical equity instrument? This I'm sure you're going to get very quickly. What is an equity instrument? You've just been learning about it recently. Type for me there. Bobby, where are you? An equity instrument would be the shares that the shareholders own, right? So there we go. Thank you, Marcy. So shares, that would be a typical equity instrument. And just for the sake of while we're talking about this, you've had this in one of the questions recently about what is it about redemption of preference shares. What would be a typical debt instrument? Something that's not an equity instrument, but it is fairly similar to it, but it's not equity, it's actually a debt instrument. Can you type something for me there that we've discussed recently that is a debt instrument? It's like a big one cut into smaller pieces. What did we call that one? There are many kinds, but the one that we've dealt with. Don't be shy. You may type there. If you're wrong, I won't laugh. Debentures. Excellent, Bobby. There we go. Sinuvuvu. Thank you, Sinuvuvu. There we go. Right. So debentures, there's also something we refer to as bonds, government bonds, and all sort of bonds. But debentures are the ones that are generally issued by companies, but they are not equity instruments. You are quite correct, Bobby. You think correct, if you know what I'm saying, in accordance with your answer. Same with you, Sinuvuvu. Yes, so debentures are typical debt instruments. Let me just see what else I wanted to. Yes. Now, if we go to paragraph 4. Paragraph 4, I'm also going to ask you a few questions here. This is, like we said, the foundation upon which many other things in financial accounting is founded. So in paragraph 4, they say to make the assessments, you can read through about the stewardship of the economic resources and so forth. In paragraph 1.3, they say existing and potential investors, which we've spoken about, or existing and potential lenders, or existing and potential creditors need information about. They need information about the following things. Now, I'm going to ask you a few questions when we read through this. They say those potential investors or existing investors or potential or existing lenders or creditors, they need information about the economic resources of the entity. They need information about the economic resources of the entity. Now we can think a little bit further. Later on, we're going to give names to this. At this stage, we are just establishing the basic principle. But later, we're going to give it names. Let's give that one a name. What would constitute the economic resources of the entity? Give it a name for me, if you can type there quickly. What would you say would be economic resources? Don't be shy. You already know this. It's just a matter of putting one and one together here. What would constitute economic resources? I want somebody to type something for me. If it's wrong, it's okay. Then we can use it as a point of departure for discussing further. Sinavuyo, give it a shot. Vavi, Marcy, give it a shot. What would you call things that represent economic resources? We will see later. Assets, there we go, Marcy. Assets, right. So we can already see where this is going. They are telling us we need to supply to those users of the financial statements. We've already given them names, what they are, potential and existing investors and so on. We've got to supply them information about the economic resources. So now we know where this is going. This is going towards assets. Now, clearly, we must also now determine where are we going to show this. So eventually we will land in a place where it says, where are we going to show assets? So if you can type there, Marcy or Sinuvuyo or Barbie, any one of you. So we have a statement that we are going to design that is going to contain our assets. What do we call that statement? Type for me quickly, please. You can just type the abbreviation, that's good enough. There we go. Thank you, Marcy. You are quick. You must tell me which coffee you use. There we go, Bobby. Thank you. Yeah, the statement of financial position. So here we can see that the principles are established, and later on we're going to develop it to see what names we are going to provide for it, where we are going to disclose it, in what kind of statement, and so forth. Okay. So we see that we've got to provide information about economic resources, but also claims against the entity, right? Claims against the entity. What does that sound like? What kind of element do you think they are referring to there? I know we're going to give it names later, but if you think about a claim against the entity, what bell does that ring? Type for me there, please. A what? A liability. There you go, Bobby. Like I say, I need to know what kind of coffee you have. That will help me as well. A liability. So clearly, we've also got to provide details to the users of the financial statements about liabilities. And while we are there, in which statement are we going to provide it? I know we're getting ahead of ourselves, but the point we're making here is these are the principles, and we're going to apply it a little bit later. So in which financial statements do we have to explain or disclose that? Statement of financial position. Thank you, Sinavuyo. There we go. So that's also in the statement of financial position. If we go to the next one, they say, and changes in those resources and claims. So in other words, what causes those resources, which we've said are our assets, and those claims, what we've said is represent our liabilities. What causes that to change? Give me. I know this is a hard question to answer, but there are basically two things that can change your assets and two things that can change your liabilities. The one kind is the profit that you make, right? Or the loss that you make for that matter. Hopefully you don't make losses, you make profits. That's the whole point. But anyway, so one of the things that can change resources and claims would be your trading. So the results of your trading would be profit or loss. And where do those trading activities come from? They come from income and expenses, right? So they come from income and expenses. So we can already think forward. Is there a financial statement that we are aware of that is designed to tell us about changes in resources and changes in claims against resources due to trading activities? Please type for me there. Is there such a statement that you're aware of? There should be. There we go. The income statement. What do we call it? We're going to talk about income statement when we discuss IAS 1. The modern term for it is either your statement of comprehensive income, or you can have a combination of a profit and loss statement and a statement of comprehensive income. That we'll discuss when we get to IAS 2. But Bobby, you're 100% correct. It is your income statement. So your trading activities can cause a change in your resources or the claims against those resources. What else can cause a change in your resources? How else can you get money, or how else can money go out of your entity, out of your company? Due to transactions with your shareholders. If you issue shares, you get more money in. If you distribute your profits for the year, your retained earnings, that means it changes your resources. So do we have a statement already that we've discussed that we can disclose those items that changes your resources and the claims against resources, but does not have to do with your trading activities? There we go. Thank you, Marcy. That was quick. Yes, your statement of changes in equity, right? Okay, so that is what I wanted to discuss there. So here we get the basic principles of what kinds of information needs to be disclosed. We've already given them names. We've spoken about 5 things, haven't we? Just during this discussion, we've spoken about assets, we've spoken about liabilities, we've spoken about income, we've spoken about expenses, and we've spoken about equity. And we've also seen that there are already statements, financial statements that are ready, that have been designed to disclose that kind of information. Okay, so we can all see where we are going here. Let me just see what else I wanted to highlight here. You can perhaps just read through that. We've already discussed economic resources and claims. We know the economic resources represent the assets. The claims against those economic resources represent our liabilities. Changes in economic resources and claims, that is either through the trading, as they also describe there, or through transactions with your equity participants. Okay, I'm going to take just a minute or two break here, just in case there are any questions, and then we are going to discuss this very important principle of accrual accounting. So let's just hear if there are any questions from your side. You're most welcome to raise your hand. You're also most welcome to type a question there in the chat box if you wish. No questions from your side? Okay, so let's talk about accrual accounting, the financial performance reflected by accrual accounting. Perhaps we must just discuss here, before we go and have a look at what accrual accounting means, we've got to discuss here the fact that we are talking about 4 kinds of financial statements at this point in time. We're talking about our statement of comprehensive income or statement of profit and loss. We're talking about our statement of changes in equity. We're talking about our statement of financial position, as well as the notes. The exception to the rule, the one that does not use accrual accounting, is our statement of cash flows. Okay, Statement of cash flow, slightly different animal. That is why it has got its own international accounting standard, IAS 7. So let us just read the first part of this paragraph 1.17, and then we're going to discuss it. They say accrual accounting depicts the effects of transactions and other events and circumstances on a reporting entity's economic resources and the claims in the periods in which those effects occur. Another word for occur is happen or take place. So occur in auditing 2, you're also going to learn a lot about a concept called occurrence. Another word for occur is when it happens or when it takes place. So they say we are going to report any changes in resources or claims, or even the claims and resources themselves, in the period in which those changes take place or occur, even if the resulting cash receipts and payments occur in a different period. We're going to discuss all of that just now. I'm just going to read this part as well. This is important because information about a reporting entity's economic resources and claims and changes in those resources and claims during a period provides a better basis for assessing the entity's past and future performance than information solely about cash receipts and payments during that period. Okay, so let us discuss what is really meant by accrual accounting. To summarize, if you want to make a little note of this, I'm going to basically repeat what is in that paragraph. I'm just going to make it a bit shorter. So accrual, the accrual system, we very often talk about the accrual system or the accrual principle. Accrual accounting simply means that you record an event or transaction when it takes place and not when the money for it moves. Okay, so you record a transaction or event when that transaction or event takes place, when it occurs, when it happens, irrespective of when the money for it flows. So let me give you possibly the easiest example of the accrual system in action. And again, I'm going to ask you to type a few things for me here. Let's say, for instance, what is today's date? Today is the 4th of August, 2020, 4th of August. If you sell goods on credit today, right? 8th of, 4th of August. If you sell goods on credit today, and your debtor only needs to pay you in 60 days' time, in other words, the 4th of October, right? When are you going to record that sale? All you need to type for me is today or not. Are you going to record that sale today, or are you going to wait until you receive the payment to record this sale? Molatisi, you are very quick as well. There you go. Today, you all know that. You're going to record it today because the sale took place today. The sale didn't take place in 2 months' time, but you didn't perhaps realize that is the accrual system in action. What we are doing is we are recording that transaction when it takes place. And then in that process of recording the transaction, we actually accrue something. What do we accrue in this case? Type for me. We data, right? We accrue the data. So the mere fact that we've got a data, there we go. Thank you, Malatisi. Melanie, I should say. There we go. So the fact that we are creating a debtors account means we are accruing the sale. So that is basically your accrual system in action. Perhaps we can just use another example. It's the same principle. If we purchase from one of our suppliers inventory, if we purchase it today, the 4th of August, and we only need to pay that supplier, that creditor, in 90 days' time, when do we record the purchase? Today or in 90 days' time? If you can type for me quickly, please. Today, there we go. Molatisi Milani. Masi, thank you. Today, right. So again, that is the accrual system in action. From an auditing perspective, it is also very important. Accrual concept is very important in auditing because clearly, if you have purchased inventory today, it means that inventory is in your warehouse as from today. So if there's going to be an inventory count, right, the inventory is your property already, even though you haven't paid for it yet. So it is in your warehouse, right? And if you do not record the purchase of it, it means you do not match your purchase with the inventory that you actually have in your warehouse. The same with the sale. If I can just perhaps bring the auditing aspect in here as well. If you sell the goods today, it means your customer is going to take it today, right? The customer is going to come and fetch it, or you're going to deliver it to the customer. So the goods are no longer in your store. It's no longer in your warehouse, right? Your customer has taken it. If you do not record the sale today and you go and do an inventory count and you see that inventory is no longer in your warehouse, you might blow your mind. You might say, oh my word, my inventory has been stolen. The inventory is gone. But fortunately, we're using the accrual system, so we have recorded the sale. So because we've recorded the sale, we know no, the inventory has not been stolen. We have simply sold it. The customer has come and fetched it. It's just that the customer hasn't paid us yet. Okay, I think it's a good time to pause a little bit there. Are there any questions from your side with regards to the accrual system? No questions? Okay, so like I said, the accrual system applies to all the other 4 kinds of financial statements that we've mentioned, except for the statement of cash flows, which we are going to be discussing in the 4th term. Okay, if there are no questions, let me, we are going to have a look at cash flows in the 4th term. Let me just see what else I want to discuss. I think that is all in chapter 1. Okay, so now let us proceed to chapter 2. Chapter 2 deals with qualitative characteristics. So in other words, what kinds of quality must the information that we provide have in order to make it useful? You remember we spoke about useful financial information a little bit earlier. We said the purpose or the objective of financial reporting is to provide useful financial information to whom? To the users of the financial statements. And who are the primary users? As we've said, your existing and potential shareholders or investors, existing and potential lenders, and existing and potential creditors, also other entities such as the revenue service and so forth. Okay, so what is going to make information, financial information that is, what is going to make it useful? So what kinds of qualities must it have in order to make it useful? The conceptual framework provides us with 2 kinds of qualitative characteristics. The first one being fundamental qualitative characteristics. In other words, something that is absolutely essential. It forms the, I almost want to say, the foundation of the usefulness of the financial information that is going to be provided. And there we can see fundamental qualitative characteristics, the ones that are being discussed in the framework. We'll discuss them soon. Is relevance, materiality, faithful representation, and then we've got a paragraph about applying the fundamental qualitative characteristics. Then we've also got what they call enhancing qualitative characteristics. So what that basically means, it is not as fundamental or as essential as the fundamental qualitative characteristics, but it improves the quality of financial information that you provide. So it enhances it or it improves it. And there we're going to be looking at comparability. We're going to be looking at verifiability. We're going to be looking at timeliness. We're going to be looking at understandability. And then there will be a paragraph again on applying the enhancing qualitative characteristics. And there's also paragraph 2.39 on the cost constraint of useful information. Sometimes we may find that there could be a cost versus benefit trade-off. We'll discuss that in a little while. Okay, so let's have a look at the fundamental qualitative characteristics first. When it comes to the fundamental qualitative characteristics, there are two mentioned by the conceptual framework. The fundamental qualitative characteristics are, first of all, relevance, right? So the information must be relevant to the situation, or relevant to the industry, or relevant to that particular entity, and also faithful representation. So if the information, the financial information, if it's relevant and if it provides a faithful representation of what actually happened in the business when it comes to the results, or when it comes to the financial position or the cash flows, then we are providing information that is useful to the users of the financial statements. Right, so let's first of all discuss relevance. They say there, let me just see, I heard a little sound. Let me just check whether it was someone asking a question. Oh, thank you. No, it's Mr. Borman providing extra information to you there. Thank you very much, Mr. Borman. So when it comes to relevance, they say relevant financial information is capable of making a difference in the decisions made by the users. We're also going to look at materiality a little bit later, because materiality does have an influence on relevance as well. Information may be capable of making a difference in a decision, even if some users choose not to take advantage of it, already aware of it from other sources. This is the important paragraph that we need to highlight. What makes the information relevant? What they are saying here, financial information is capable of making a difference in decisions. In other words, have an effect of whether somebody is going to provide you with a loan or not provide you with a loan, or whether they're going to open a credit account for you or not a credit account for you, or whether some other financial institution or individual wants to invest in your shares or not invest in your shares. So if it makes a difference in the decision, like I said, we're also going to talk about materiality later, which plays a role in this. When will it make a difference? If that information has either got a predictive value, we're going to talk about that just now, or it has confirmatory value, or it has both a predictive value and a confirmatory value. Now you can read through those paragraphs. I just want to talk about that in general. So let's maybe start with confirmatory value. What is confirmatory value? That confirms something that happened in the past. Now, by its very definition, financial statements provide to you with historical figures, right? What happened during the course of the year ended, let's say, 30th of June 2020, right? So that is confirmatory value. So if it provides the users of the financial statements with information that confirms the financial position of the company, or the cash flows of the company, or the results of its operations, then we say it has confirmatory value. Predictive value means we are looking into the future, right? Now, you know, history tends to repeat itself. Companies, I know that we're in a in a COVID-19 pandemic, so the world has changed dramatically over the last 5 or so months. But normally, what happened in the past tends to happen in the future, right? So if a company, let's say, for instance, had 5 million rands of sales last year, and 5 million rands worth of sales the year before, the chances are pretty good that they will have 5 million rands or plus minus 5 million rands worth of sales next year, right? So you can use the financial statements from the previous year to or the 2020 year to predict what will in all probability happen in the next year, the 2021 year, right? So if that information provides you with predictive or confirmatory values or both, then we say the information is relevant, right? So that is where the term relevance comes from. So let's maybe just talk about materiality, because that also plays a role in whether information is relevant or not. What I'd like you to do here, students, I'd like you to write down a little definition. The conceptual framework explains materiality in IAS 1. It also has a paragraph on materiality, but I think the best definition for me personally of materiality comes from the ISAs. ISAs stand for, excuse me, International Standards on Auditing. The international standards of auditing, the ISAs, remember, are not the same as the IASs. The IASs, they are the International Accounting Standards, and they are published by the International Accounting Standards Board. Whereas the ISAs, not IAS, but ISA, the ISAs are published by the International Federation of Accountants, or IFAC. They are situated in the United States, whereas the IASB is situated in the United Kingdom. But anyway, the ISAs, there's an ISA that deals with materialities. Perhaps you can just write the definition for me there. This is quite an important definition for me personally, because I also deal with auditing. I practiced as an auditor for a long time. So I want you to really understand this, especially since many of you intend to become auditors. I guess a quite large or a substantial number of you are enrolled in this course in order to become auditors. So if you can please make a note there, the definition of materiality from the point of view of the ISAs, or auditing. They say an item is material. You can just write perhaps down there. An item is material if its omission, OMISSION. What does omission mean? What does omission means? Omission means you accidentally leave it out, right? Omit it, you leave it out accidentally. So an item is material if it's omission or misstatement. Misstatement. And this has nothing to do with Miss South Africa or Miss World or Miss America, right? Misstatement means you are not omitting it, you haven't left it out, but you are disclosing it at an incorrect amount, right? That is a misstatement. In auditing, they go further and they say understatement and overstatement, but that's for auditing. So an item is material if its omission or misstatement will influence the economic decisions. The economic decisions made by users based on the information provided, right? An item is material if its omission or misstatement will influence the economic decisions made by the users of the financial statements, in our case, of that financial information provided. Sorry, I just needed to point that out.
Sorry, Mr. van Rensburg, we can't hear you at the moment. Can you just use the last words we heard was we need to point that out.
Oops. Okay, where was I? Did I finish with the definition? Did I say the full definition from ISA 2000? Okay, thank you. Right. Okay, so I was just thank you. So I was just going to provide you with an example. Sorry, I wanted to switch off my camera, and I think I accidentally switched off my microphone. I wanted to hide the fact that I'm giving you a bad example here. Now you probably saw that I'm giving you a bad example. Thank you, Bobby. Thank you, everyone. So let's say we are not in a COVID-19 situation. We are actually all on campus. So you own a pet, you own a dog at home. So you are on campus for attending your classes. But then you realize, oops, I've got no more dog food at home. I must buy some dog food on my way back. But let's say you are living, your residence is 3 kilometers from the campus, right? So you walk home, and 1 kilometer from campus is the first shop. And let's say this is a Pick n Pay, right? So here we stop at Pick n Pay. We go and have a look at the bag of dog food. We see the bag of dog food costs 40 rands, right? And then you say, oh, but it's still 2 kilometers to get home. I don't want to carry this heavy bag of dog food for 2 kilometers. I'm rather going to walk another kilometer closer to home. There's a Checkers, and then I'll buy it there. So go to the Checkers, which is a kilometer closer to your home. You get there and you see that same bag of dog food costs you, let's say, for instance, 120 rands. Right, I know this is an extreme example, but let's say it's 120 rands. What would you decide? Would you decide to go back to the first shop, let's say Pick n Pay, and go and buy it for 40 rands, or will you still go and buy it for 120 rands here at the Checkers? Let's say. What would you do as a reasonable person? Money is tight. Yes, thank you, Malatisi. You'll probably say, I'm going to go back to that first shop because I can buy it substantially cheaper there. So that means that has changed your decision. The fact that it is much more expensive has changed your decision. You are now going to go back to Pick n Pay and buy it too for 40 rands instead of 120 rands. So in effect, you have decided that the difference between the 40 rands and the 120 rands is material. It is significant enough for you to change your mind. So it has influenced your economic decision, right? So you have decided it is material, and like I say, that changed your economic decision. You're not going to stick with your original decision to buy it here at Checkers. You're rather going to go back and buy it from Pick n Pay. So you have changed your mind, right? Let's say in the same situation, you saw that at Pick n Pay, which is 2 kilometers from your home. That bag of dog food cost you 40 rands. Now you get to Checkers, which is a kilometer closer to home, and there you see it costs, let's say, 45 rands, right? 45 rands. What would your decision now be? Am I going to walk a kilometer back to Pick n Pay, buy it for 40 rands instead of 45 rands, and then walk another 2 kilometers back home? What would you do? Rather buy it at Checkers for 5 rands more, or go all the way back to Pick n Pay? In other words, you're going to walk an extra 2 kilometers. 1 kilometer back and that same kilometer again. Yes, right, we are all sensible people, right? We'll say, okay, right, it's 5 rands more expensive, but I'm not going to change your mind. Thank you, Marcy and Molatisi and Sinevuyu. Yes, you're going to buy it there. So in this case, it did not change your economic decision, right? You didn't change your mind. You are still going to buy it at the shop closest to home, which means that you've decided that that difference of 5 rands is not material. It's not significant enough for you to change your mind, right? So you decided it is immaterial. Students, I know I've seen in the past that students confuse materiality with materials, right? This is not materials. It's got nothing to do with physical inventory. It's a concept of materiality. We'll see later on when we discuss IAS 1. We can look at materiality from a quantitative point of view as well as a qualitative point of view, but we'll discuss it when we get to IAS 1. The fact is, in our example, we decided that the 5 Rand is so insignificant, that difference, that it's not going to change our original decision. It's not changing our economic decision. So we consider that difference to be immaterial or not material. Whereas the difference between 40 Rand and 120 Rands, we consider to be material. In fact, we can buy 3 bags for 120 Rands if we go to the closer shop, right? So that we have decided that is material. Okay, so that goes hand in hand with relevance, if it is relevant or not. Then we've got the second fundamental qualitative characteristic, which is faithful representation, right? Faithful representation. Again, let's go and have a look at the second paragraph under faithful representation. When is financial information faithfully representing what happened in the company? They say to be a perfectly faithful representation, a depiction would have 3 characteristics, so 3 different characteristics. It must, first of all, be complete, right? It must be complete. So there must be nothing missing. Secondly, it must be neutral. And thirdly, it must be free from error, right? They say there, of course, perfection is seldom, if ever, achievable. But clearly, we strive to make it as complete and as neutral and as free from error as possible. Right, so if we perhaps just briefly look at complete, what does it mean? If the information is complete, it means nothing has been left out that is relevant, right? If there's anything that is relevant to this entity's financial matters, they have all been included in the financial statements, right? Neutral simply means it is unbiased, right? It is unbiased. You are not advocating an opinion here, right? In auditing, you'll also learn that very often management of a company may want to show a much better picture of the company's financial position, right? So they may want to overstate assets, or they might want to understate the liabilities of the company in order to show a better picture, a better financial position. Or they might want to overstate their sales and understate their expenses in order to show a bigger profit. And that could simply be to impress their shareholders, or to impress the holding company, or to be able to obtain a loan from a bank, right? So then those financial statements have been manipulated. They are not neutral anymore. They do not present the truthful facts anymore. So it's not a faithful representation, because they have been manipulated to show a better picture. Or if the company simply wants to evade tax, they might want to show a worse picture, right? And then it should be free from error. Now, the free from error is quite a contentious issue, because as we know, financial statements very often contain estimates. For instance, when we provide depreciation in the case of property, plant, and equipment, we have to estimate the amount that we can sell it for at the end, which we call the residual value. It's an estimate. We cannot definitely say that in 5 years' time we're definitely going to sell it for, or be able to sell it for 20,000 Rand. So it's an estimate. We have to estimate the useful life of that asset. We cannot definitely say the asset is going to last us 5 years or 10 years, because we might be using it for 2 years only, and then it's completely exhausted, right? So there are certain estimates in our financial statements, but what the conceptual framework basically guides us, excuse me, is if you are using a proper basis for doing the estimate, if you've got you can almost call it a scientific basis whereby you do the estimate, and if you also disclose the reasons for your estimates, for instance, that you're using 5-year as an estimated useful life and that you are using 50,000 as an estimated residual value, then it is still regarded as being free from error, right? So it doesn't have to be all, let's say, invoiced amounts. It can still be estimates as long as those estimates are solid, has a solid foundation, and it is also disclosed. Okay, let's see what else we need to discuss. Now we are going to look at the enhancing qualitative characteristics, but perhaps we can just take a 60-minute break here just to check whether there are any questions from your side. Mr. Siwe, no worries. You might just have a little bit of a networking problem there. It is being recorded. I know you probably can't hear me now, but we will load the recording later. Any questions from your side? Thank you, Mr. Borman, for typing the material definition there as well. Okay, so then let us proceed. So now we're going to look at enhancing qualitative characteristics. In other words, certain qualities that can make the financial information that we are presenting even better. Here they provide us with a number of enhancing qualitative characteristics. First of all, comparability. We're going to discuss that just now. Comparability. Verifiability. Don't know why I always miss that first little. Verifiability. The third one is timeliness. And then the last one is understandability. So 4 of them, they are the qualitative characteristics that improves the usefulness of information. That is why it's called the enhancing qualitative characteristics. So let us go and discuss each of them individually. When it comes to comparability, I just want to check quickly. I've heard a few sounds. Oh, thank you. It's Mr. Borman typing there. Much appreciated, Mr. Borman. I was just checking whether anybody put up a hand. Now, you remember right at the beginning of this class, we said that it is quite important for the users or the potential investors in a company, which are amongst the users of the financial statements, to be able to compare oranges with oranges or apples with apples, right? So whether that company is situated, let's say, in the USA or in the UK or in Nigeria or in Zimbabwe or South Africa, Australia, we must still be able to compare the financial statements of the one company with the other. So when it comes to comparability, there are actually 2 aspects that we need to look at. First of all, the comparability between different entities, company A and company B. So we must be able to compare the financial statements, and remember that includes the results of the operations, it includes the financial position, it includes the cash flows, amongst other things, right? So we must be able to compare, let's say, company A, which is situated in Nigeria, with company B, which is perhaps situated in Australia for that matter. Okay, so comparability between different entities, even from different countries, must be or should be possible. Now, clearly, that provides us a good reason why there are some things called international financial reporting standards, or IFRS. That is truly to make the financial statements between companies globally comparable, right? So that you can compare company A, which has its financial statements drawn up in one country, to company B, which has its financial statements drawn up in another country. You can compare it because they are using the same international financial reporting standards, the same standards that have been issued by the International Accounting Standards Board. But we must also be able to compare one specific company. We're only looking at one company, company A, from its one financial period to the next and to the next and to the next. So we must be able to compare the 2020 financial results, for instance, with the 2019 financial results or financial position for that matter. And also with the 2018 and the 2017, which means there's got to be consistency in preparation of the financial statements, right? A company should just go and randomly chop and change their accounting policy. One year they use, let's say, the straight line method for depreciation. The next year they use for that same kind of asset the diminishing balance method, and the next year they use the sum of digits. Right, so they mustn't jump around with just willy-nilly changing their financial policies, right, or their reporting policies, their accounting policies. So there's got to be consistency from the one year to the next. As we'll see later, that doesn't mean a company cannot change its accounting policies. There are sometimes solid reasons why a company may have to change their accounting policies, but it shouldn't be randomly applied, right, just for the sake of changing, because then it makes the comparability between different periods virtually impossible. Let's have a look at the next one, verifiability. You'll also hear the term verification a lot in auditing. Verification can either be direct or indirect. If we have a look at that that second paragraph there, a typical example of direct verification is, let's say you purchase an item from a supplier, right? That supplier will provide you with an invoice. They call it the sales invoice, you call it a purchase invoice, but it's the same thing, right? On that invoice, it will detail the purchase price, right? So if that purchase price agrees with the amount that you've capitalized as the purchase price, when you calculate the cost of the item that you are going to record, then it means it can be directly verified, right? So the verification is possible. The same with, let's say, something like an inventory count. If you do an inventory count at the end of the year, you are going to count all the items in your warehouse and in your stores and on your shelves, so you know which types of items you have, how many of each type of item you have. You can go and do a costing exercise with the help of your purchase invoices. That's when we get to first in, first out, and average cost method and so forth. So you can directly verify the value of your inventory on hand, right? Or you can get a bank statement, and that is a direct verification of the bank balance at the end of the month, the various transactions that have occurred during the month. Or there can be indirect verification. The fact remains that the information can still be verified. A typical example of indirect verification is the use of a perpetual inventory system. As you know, when you use a perpetual inventory system, you not only record sales, but you also record the cost of sales, right? So when you start with your opening inventory and you add the items that you've acquired, purchased during the course of the year, and you deduct the cost of the items that you sold during the end of the year, that gives you a theoretical value of what your inventory should be at the end of the year. So that is, you've done a calculation. You haven't used a document, a source document, such as an invoice or a bank statement to calculate the value of your inventory. You've used a calculation to arrive at your closing inventory, and that is an example of an indirect verification of the amount that you are disclosing, or the facts that you are disclosing. Then timeliness, this also makes the information more useful or better. It enhances it. Timeliness. Now, clearly, ladies and gentlemen, I think this is possibly the easiest one of all to discuss or to understand. If you are going to have to make a decision, am I going to buy shares in company A or B or C or D? And I have and we are now at the 4th of August 2020, and they provide us their financial statements for, let's say, the years ended 30th of June 2016 or 2015. It means a lot could have changed in the meantime. Those information is ancient almost, right? That information might not even be relevant anymore. So clearly for information to be useful to the users, it must be prepared as soon as possible after the financial year end. So the more recent the information, the more useful the information. 4 or 5 years ago's information is not even relevant anymore. So the timeliness is an enhancing qualitative characteristic. So it makes the usefulness of the information much better. Then lastly, the matter of understandability. Perhaps we can again go to the second paragraph there. They say some phenomena are inherently complex and cannot be made easy to understand. Excluding information about those phenomena from financial reports might make the information in those financial reports easier to understand. However, these reports would be incomplete and therefore possibly misleading. Okay, so that is a fairly complex little sentence there. They're not only talking about phenomena that are inherently complex, but also quite a complex sentence there. Let's perhaps just think about a shoe manufacturer. A shoe manufacturer, if they provide you in the financial statements with the sales of the shoes, the purchases of the shoes, in total, then clearly the information is relevant and the information is understandable, right? But if they provide you in the financial statements, let's say about 700 different kinds of shoes that's part of their inventory, right? They are from size 1, 2, 3, 4, 5, 6, 7, gentlemen's, and 1, 2, 3, 4, 5, 6, 7 for ladies, and some are galoshes, and some are boots, and some are all sorts of things. Some are made of leather, some are made of rubber. This particular shoe contains 50% rubber, 20% leather, and 5% something else. Do you think all of that information is, first of all, going to be relevant to the users of the financial statements? Do they care what each shoe is made up of, or do they only care about the profit you've made from selling and buying the shoes and the relevant expenses? All of that other information would not be relevant, and even for me and for you, it might even be more than irrelevant. It might be not understandable. I almost said ununderstandable, and then I realized I don't think there's a word like ununderstandable. But it might make it not understandable, right? The same with certain engineering facts and figures that could be provided for financial statement purposes that could be totally ununderstandable, not understandable for the users of the financial statements. I don't care what percentage of oxygen and nitrogen and whatever kind of elements are included in a product. I just want to know what is the cost price, what is the selling price, and what was the profit I made from it. Okay, ladies and gentlemen, the cost constraint in useful financial information, you can perhaps just have a read through that. It just deals with sometimes a financial accountant is in the unfortunate position that the cost might not justify the effort or the means, right? So sometimes let's say to get everything 110% accurate might mean that you cannot complete the financial statements in time. So sometimes you have to compromise a little bit there. They very often refer to it as the cost-benefit trade-off, cost versus benefit. Right. Then just the going concern concept that I'd like to discuss under chapter 3. So let's perhaps just go to the going concern concept. You can read through these intervening paragraphs, but we've already discussed that when we said when it comes to your resources, it depicts assets. When it comes to your claims against resources, it depicts your liabilities, and we've also discussed where we will find all of those all of those information in which financial statements, as well as the notes. So you can perhaps just read through that again. Reporting period, we will discuss when we get to the International Accounting Standard number 1. Okay, so let's just talk about the going concern assumption. They say the financial statements are normally prepared on the assumption that the reporting entity is a going concern and will continue in operation for the foreseeable future. Hence, it is assumed that the entity has neither the intention nor the need to enter liquidation or to cease trading. If such an intention or need exists, the financial statements may have to be prepared on a different basis. We're going to talk about that just now. And if so, the financial statements must describe the basis used. Okay, so what they are saying here, this is an assumption. This is an assumption. When we draw up the financial statements, we are going to prepare it as if the company is a going concern. What does it mean if the company is a going concern? It simply means the company is going to carry on. The company is going to carry on trading into the foreseeable future as it has in the past, right? So there is no idea that they are going to close business or that they must be liquidated. The fact is, the going concern assumption provides us with the basis on which we are going to measure our financial statements. So it all has to do with measurement. So if we regard it as a going concern, it means that the financial statements are drawn up on the going concern basis. So that in turn means we regard that the company will continue trading into the future as it has in the past. Now, later on, when we get to IAS 1, we're going to briefly discuss this again. We'll see that the measurement of a non-current asset such as property, plant, and equipment, it basically represents your future economic benefits, right? So the value of, let's say, your motor vehicles or the value of the plant and equipment represents the economic benefits that you can still get from it in the future. And when we get there, we'll see that your future economic benefits can be determined in a number of ways. We'll actually talk about it later under the conceptual framework as well. There are two ways that you can determine it. First of all, what can you sell it for today? So if you determine what you can sell the asset for today, it means you are not going to be using that asset in the future anymore, right? So that means what you can sell it for today is in effect a liquidation value. So if we should stop trading today, what can we sell the asset for? Or in the case of a liability, if we should stop trading today, what do we have to pay to settle that liability, right? Obviously, we're not going to be paying interest into the future, which we might have calculated already. But in the case where we are going to continue trading into the future, we are not going to use liquidation values. In other words, what we can sell it for today in the case of an asset, or what we need to settle a liability with today, but rather what are the benefits, the economic benefits that can still be provided by this asset into the future. So there we are going to look at what we refer to as its value in use. So perhaps you can already distinguish between two kinds of measurement bases here. The first basis being what we can sell it for today, so that is basically a liquidation value, or what we can generate from using it into the future, so that is its value in use. Okay, the reporting entity, we are going to be talking mostly about companies in financial accounting too, but a reporting entity can be any entity that trades, or even a non-profit organization that has to produce financial statements. Okay, so let us pause there for a minute or so, and then we are going to look at the elements of financial statements. Don't know if anybody else wants to say something or ask something, so let us give you a minute or so if you want to raise your hand and ask maybe a question.
Mr. Rensburg, it's another 20 minutes before it's 1 o'clock. Maybe we should just bear that in mind.
Yes, good point. Thank you, Mr. Borman. 2 o'clock, oh, sorry, not 2, 1 o'clock is our cutoff time, ladies and gentlemen. I know that the session has been booked until 1:15, but we don't want to spend more than 2 hours at a time. We know that that is already long enough. Okay, so let's see how far we get with the elements. Whatever we don't finish with, we'll carry on with on Thursday. On Thursday, we're going to have another session from again from 11 till 1. Then we'll complete the conceptual framework. We'll also start with IAS 1. Like I said a little bit earlier, for me this is one of the more important chapters because it provides us with the elements of financial statements. Now, I know this is a little tongue-in-cheek, but in which other subject at school have you heard about elements? Perhaps somebody, one of you students, can type for me. I'm not sure whether all of you had that subject, but where else have you heard about elements? In what other subject, perhaps at school? Physics, there we go, or chemistry. Thank you, Bobby. Physics as well as chemistry, we get, I said earlier, I'm going to mention the periodic table. In chemistry, we have the periodic table, which contains the basic elements of everything. Right? Everything in the universe, our own bodies, water, air, whatever kinds of gases in the air, there are certain elements that eventually make up all material. Now I'm not talking materiality, now I'm actually talking material. All material in the universe is made up of certain basic building blocks. So let's call elements the building blocks. So building blocks, if we look at the very first element on the periodic table, perhaps you can, those of you who've had chemistry can type for me, what is the very first, the lightest of all elements? It's only got one little atom. Not atom, neutron, I should say. Proton and neutron. It is hydrogen. Hydrogen, it's only got one neutron, one proton, and it's got a little electron circling around it, right? Hydrogen. Then what is the second one? It's got two protons, two neutrons. It is helium, and so you can carry on. Hydrogen is such a light element, it's lighter than the air, right? That is why if we put helium or hydrogen for that matter into a balloon, the balloon rises, right? Because it's lighter than air. So we've got elements like hydrogen, we've got oxygen, we've got helium, we've got lead, we've got gold. Those are the basic building blocks of all material in the world. And you can even combine some of them. Now you can type for me, if you combine two hydrogens with one oxygen, what do you get? Two hydrogen with one oxygen, you get H2O. There we go. Thank you, Bobby. We get H. There you go, Molatisi. Thank you. We get H2O. And what is H2O? 2 molecules of hydrogen, 1 molecule of oxygen. It's water, right? Pure drinking water. There we go. Right, so pure drinking water consists of 2 different elements. 2 molecules of the element hydrogen and 1 molecule of the element oxygen. And so we can carry on. If we look at something like, for instance, what else can I think of? Hydrochloric acid, for instance. We'll see that it contains a certain number of molecules of chlorine and so forth, right? But those building blocks eventually make up all material in the universe, or in the known universe. Perhaps I should say known universe, because there are all sorts of theories that there may be parallel universes, but that's a story on its own. Okay, so if we move away from chemistry or physics, in our case it was chemistry, if we move away from that and we go to financial accounting, we also get certain building blocks, but in this case, not the building blocks of material, but the building blocks of our financial statements. So what are the building blocks of our financial statements? Fortunately for us, there are only 5. In the case of chemistry, the periodic table, there are more than 120, and every once in a while a new one is discovered. So we've got 5 basic building blocks of financial statements. What are they? Let's type them individually, ladies and gentlemen. Let's type them. What is the basic building block that represents the resources of the company? I know you typed it earlier already. What are the basic building blocks of financial statements? The one that provides us information about the resources of the company. Assets, right? Another basic building block. There we go. Thank you. Assets. Thank you all. Another basic building block that provides us information about claims against those resources. What do we call them? Liability. There we go. So liabilities. Thank you all. You are very, very clever and very awake. Right, so there are various building blocks. We referred to all 5 of them earlier. So we've got assets, liabilities, income, expenses, and then also equity. So now we have to go and have a look at the definition of each of them. Like we've said right at the beginning of the class, why we need to understand and know the definitions is very often we get a gut feel. If we buy a motor vehicle and we're going to drive to work with it, we know it's an asset, right? If we put petrol in the tank, we know that it's only going to last us a week, then we've got to put more petrol in the tank, so we're going to use it up within a week. So that cannot be an asset, that's going to be an expense. We only use it for a short period of time until we've driven all the petrol that was in the tank, right? So we've got a gut feel already. What is an asset? What is an expense? What is an income? What is a liability? But sometimes we get a more complex situation, something that is not as obvious as a motor vehicle or as the fuel you put in the motor vehicle. And then you've got to make an educated decision. This amount that I'm paying for, should this be described as an asset, or should this be described as an expense? Or if I get money from some source, if I receive money, should I pay this back at some point in time, in which case it will be a liability? Or can I keep this money? What is that then? Is it an income, or is it a contribution from an equity participant? What should that be described as? Asset, liability, income, expense, or equity, right? So for those more difficult situations that we may encounter in our professional lives as professional accountants, we have to know the definitions, and we must also be able to apply the definitions, right? Like we said a little bit earlier, when we get to the further standards, the IASs and the IFRSs, then we will find further definitions, but that will be a definition for a particular kind of asset or a particular kind of liability. What makes an asset, for instance, PPE? That will be a further definition. Or what makes a liability a financial liability? But that will be a further definition. But that we get in the subsequent standards, and it only applies to that particular asset or that particular liability. Okay, this one is for general application. So let us have a look at an asset. We've already said that an asset is the element, right? So the element is an asset. What does it represent? It represents the economic resources of the company. So how are we going to define it? Right here we've got a definition in our conceptual framework, and perhaps we can just break it down into certain components, right? The first little component that we have to understand, it is a present economic resource. Oops. A present economic resource. Excuse me, we'll see a little bit later what is meant by resources and so forth. So it's a present economic resource. In other words, it's something that we're going to be, that we already own or already have use of, right? That can produce income for us. It must be controlled by the entity. It must be controlled by the entity. Now, we can have a long discussion on that, which we won't, but it means the entity must have control over it. In other words, the entity must either own it, or if they don't own it, they must have something that is similar to the ownership. In Financial Accounting 3, you'll learn about something we call finance leases. A finance lease is a way of funding or financing the acquisition of an asset, but you don't actually buy the asset, but you've got all the benefits and all the responsibilities of ownership of that asset. You are going to use the asset as if you own it, even though you don't legally own it, right? The fact is, it must be controlled by the entity. In auditing, you'll learn about an assertion called rights, which will also then come back to this definition. And it must be as a result of past events, right? So it's a present economic resource. Those are the three components. A present economic resource. It must be controlled by the entity. And that control must happen as a result of something that happened in the past, a purchase transaction or a finance lease. Then they go further and say, what is meant by an economic resource? So what is an economic resource? First of all, it is a right. And that brings us back to auditing. In auditing too, you'll learn about rights and obligations, for instance. That is the same meaning as we have here. An economic resource is a right that you have. And that right gives you the potential to produce economic benefits, right? Now, ladies and gentlemen, do not, I know sometimes, not many, but sometimes students says or write there that it must produce cash. The economic benefit isn't necessarily in the form of cash. It can be another kind of economic benefit. If we think about the accrual system, just as an example, excuse me, where we record a sale even before we receive the money, we still have created an economic benefit in the sense that we have accrued it in a debtors account, right? So the debtors account represents an asset that has increased even though we haven't received the money yet, right? So please do use the term economic benefit and not simply cash. Then a liability. What is a liability defined at? It is a present obligation. So it's an obligation now, a present obligation. An obligation in the future, sometimes we will see later on, not this week, next week probably. Sometimes a company commits itself to let's say capital expansion. So they sign a contract or an agreement with a supplier that they're going to purchase something next year. But that is just a future commitment. It is not a present obligation. They do not owe the money for the stuff they're going to buy next year, even though they've committed themselves to buying it next year. So this is something that they've already purchased, haven't paid for, so it is a present obligation of the entity to do what? To transfer an economic resource, right? So now it doesn't provide an economic resource. You are going to transfer an economic resource, mostly in the form of cash, but it doesn't have to be in the form of cash. You can use, for instance, an old motor vehicle of yours, like we'll see in the third term, as payment for something, right? Or any other kind of assets, but something that represents an economic resource you're going to transfer out of your entity, and again, as a result of something that happened in the past, so as a result of past events. Then simply equity is a very, very simple and straightforward little definition. Equity is simply the residual interest. In other words, what remains. Residual interest simply means what remains. Residual interest in the assets of the entity after deducting all its liabilities, right? So equity is simply what remains once you've taken the assets of the company and you've deducted all the liabilities. That then represents the equity, and the equity belongs to the equity participants, which, as you know, in the case of the company, is simply the shareholders. Any questions so far? All happy? Like I said at the beginning, a lot of theory. We have to know the theory and we have to be able to apply it before we can put it into practical application, which we'll do next week. Okay. Then when it comes to the changes in economic resources and claims, we said it can either be through expenses or income or expenses, or through changes in equity, right? Like we have here, changes in economic resources, but this is due to equity changes and not due to profits or losses. So what is income? An income is an increase in assets, right? An increase in assets, or, and ladies and gentlemen, that little word is very important for us. It's not and, it is or. It cannot be both. It is either the one or the other, not both. Okay, so income is either an increase in assets or a decrease in liabilities, right? That results in increases in equity. So it does increase your equity, but that increase in equity is not because you have issued shares to your shareholders. In other words, other than those relating to contributions from holders of equity claims, right? So to summarize that, it means that it either increases one of your assets or it decreases one of your liabilities, and that will result in your equity increasing, but that increase in the equity is not because you've received more money from your shareholders, it's because you've made a profit. So I know that we are slowly running out of time. We've got about 6 minutes. We can actually go a few minutes over time, so I just want to finish the definitions if possible, ladies and gentlemen. So let's just think of an example here. Let's say, for instance, you have got a positive bank account, right? You've got a positive bank account. You've got money in the bank. Is that bank account then an asset or a liability? If you can type for me there, please. If you've got a positive bank account, you've got money in the bank, is that an asset or a liability? It's an asset, right? Quite correct. Thank you, Molatisi, Melani, Masibonku. Thank you. It's an asset. Now, if you sell something, let's say you do a cash sale, we're talking about income. You've got a cash sale. If you've got a cash sale, is it going to increase that asset or is it going to decrease the asset? You are, in other words, selling something, you receive money, you deposit it into your bank account. Is it going to increase or decrease the asset? If you can type for me, please. Decrease or increase? You sold something for cash, you deposit the money into your bank account. The bank account is an asset. Is it going to increase? Thank you, Molatisi Melani. You're going to increase the asset, right? So therefore, that sale will qualify in terms of the definition of income as income. Let's look at the second possibility. Let's say you do not have money in your bank account. You've got a bank overdraft, right? You owe money to the bank in effect. So if you've got a bank overdraft, is that then an asset or a liability? You can just type that for me, please. Yes, then it is a liability, right? So thank you. The bank account, the bank overdraft, like you say, there is a liability. So let's say again you've got a cash sale. You're making a cash sale. So you are selling something to a customer, you receive the money, you deposit it into the bank account. You said that is a liability. Now when you receive the money and you bank it into your bank account, will that overdraft become bigger or smaller? You can just type for me, will your overdraft now be bigger or decreased? Thank you, Molatisi Melani. You've already guessed where I was going. In other words, it's going to become smaller. Your liability, the overdraft, is going to become smaller. You owe less money to the bank because you deposited money into the bank account. So that results in a decrease in the liability, your bank overdraft. Okay. Expenses is almost like the mirror image. An expense will be a decrease in assets, so it's going to decrease your assets, or again, it's not an and, it's an or it's an increase in liabilities. Yes, that will result in decreases in equity. So the equity is now going to become less because of that expense, but your equity does not decrease because you are distributing a dividend. It is because you are paying an expense. So therefore it carries on and it says other than those relating to distributions to holders of equity claims. So that refers to, in the case of a company, to dividends, right? So you are not decreasing your equity because you are paying dividends to your shareholders. You are decreasing assets and decreasing equity or increasing liabilities because of expenses that you've incurred, right? We can use the same example there. If we have a positive bank account, if we've got money in the bank and we are going to do a cash purchase, we purchase something from a supplier, we pay them the cash, will that mean our bank account, which is an asset, will it decrease or increase? If we pay money to the supplier out of our bank account and we've got money in the bank, it's a positive balance, it will decrease the asset, quite correct, right? But on the other hand, let's say we've got a bank overdraft. Now it's not an asset anymore, it's a liability. If we pay money out of that bank overdraft, is it going to increase or decrease the overdraft? There we go. Wow, you're quick on the trigger here. Thank you all. Yes, it's going to increase the overdraft. So again, that purchase then does qualify. It does qualify as an expense because it either decreases the assets or it increases the liabilities, and we know that will then result in a decrease in equity, but that decrease is not due to a distribution made to our shareholders, the holders of equity claims, right? And then just our last little point, I see it's 1 o'clock for today. Other changes, we've spoken about changes in economic resources and claims against economic resources. We said it's either from profits or losses, or it can then be from contributions from your shareholders, the holders of equity claims. In other words, you are issuing shares, for instance, or it can be distributions to them, such as a dividend. And those will obviously then not be in your statement of comprehensive income, they will be disclosed in your statement of changes in equity. Just before we finish, ladies and gentlemen, let me just quickly have a look. You can have you can look at the rest of the paragraph. As you know, this document is available on Blackboard under content. It's also discussed in chapter 2 of Gripping GARP. There is another chapter that I want us to look at, but I guess we'll have to do that tomorrow. There we have the definitions again. There they just provided to you in more narrative form. Result of a past event, but we must still have a look at the measurement basis. Let me just, that you can leave out. Executory contracts you can leave out. Don't worry about reading that. Contractual rights you can ignore for the time being. There we've got the definition of equity, income, expenses. So next time on Thursday, ladies and gentlemen, we're going to look at recognition and derecognition. We are also going to be looking at the measurement bases that are allowed by the conceptual framework. Let me stop sharing. Excuse me. So we're going to complete the discussion on the conceptual framework on Thursday. Thursday again, ladies and gentlemen, at 11 o'clock. 11 o'clock until 1 o'clock. Hopefully we don't go overtime again. But then we'll just finish the discussion on the conceptual framework, and then we're going to start talking about International Accounting Standard number 1, which deals with the presentation of financial statements. More theory for your pleasure for a while, and then next week we're going to start applying it in practical situations. Okay. Thank you all for attending. Are there any questions? Our session finishes officially now, but we have got a few extra minutes in the bank. We've got a positive bank balance. Anyone wants to ask questions physically? No questions? Okay, then hopefully I'll see you all again on Thursday at 11 o'clock. The Cape Town students, ECP, as well as any other full-time students, as you know, you can just log on to Blackboard, go to the Financial Accounting 2 site, click on Virtual Classroom. But if you're from the Wellington campus or from the part-time group, then you must click on the link that I will send you because we are using the full-time website as the host of the presentation. Thank you very much. Yes,
can we just quickly go and talk about the test on the framework? It starts at 4 o'clock in the afternoon, is that right?
Yes, that is correct. The class test starts at 4 o'clock. Yes, quite correct. Perhaps you can talk about that. I'm trying to think now. It's from 4 o'clock. I think they've got 45 minutes, or is it 1 hour? I forget now.
Yeah, I'm not sure, but they will see when they log in at 4 o'clock.
Yes.
Remember, that test is on the 18th, Tuesday, the 18th of August. And then the next Tuesday, the 25th of August, you write the 2-hour test, the formal test 1, which will deal on IAS 1 and the presentation of financial statements. So basically, the stuff which we've dealt on today is in the class test 1, which will be written on the 18th of August, Tuesday, the 18th of August, 4 o'clock. I just want to make that very clear because I think sometimes students get confused what is tested in what test. Thank you, Mr. van Rensburg, for your class. It was most informative. I've put under the chat section, last of all, a little true-false question answer, the purpose of the conceptual framework, and that's a typical type of true-false question you will receive in an exam paper. Thank you, Mr. van Rensburg. Over to you again.
Thank you very much, Mr. Borman. Thank you for providing clarity on that. Perhaps you just reminded me of something else that we should just perhaps tell the students now. In the case of the class test, because it deals with a theory of the conceptual framework, you are not going to be presented with a question paper beforehand like you did with the formal test 2 and like you will with the formal test 1, which Mr. Borman said is on the 25th. There again, you will be presented with a question paper. You must draw up financial statements, and there'll be an online test afterwards. But in the case of the class test, it is just an online test. So 4 o'clock when you start with your online test. And like Mr. Borman said, there will be true and false questions or multiple choice questions or multiple answer questions. But those questions will only be asked during the online test. Anything you want to add there, Mr. Borman?
No, Mr. van Rensburg, you've explained it very well. Thank you very much. Bye-bye.
All right, bye-bye, everyone. Hope to see you all again on Thursday at 11 o'clock. Cheerios. Enjoy your day. Go and do some reading on that conceptual framework. Bye.